Hello, welcome to PrimeInvestor. Recent changes in the budget with respect to EPF has created a lot of confusion in the minds of investors. So today we have Aarthi Krishnan to explain what these changes are and what they mean to you. Hi Aarthi.
Hi.
So what exactly is the change that the budget brought about?
So, to give a little bit of background about the EPF itself, as you know, in India, any organization with more than 20 workers has to have a enrollment with the Employees Provident Fund organization. And as soon as you join your job, actually you contribute 12% of your basic pay plus DA to the EPF, and your employer also chips in with the equal contribution. And some portion of the employer's contribution goes to the pension scheme, but that's not very relevant for high income earners. So so far this EPF has enjoyed something called a EEE tax treatment, triple E tax treatment, which means that the money that you put in gets tax exemption under 8TC. All of us know that. The interest that you earn on this also gets a tax exemption, completely exempt. And finally, when you retire and get the maturity proceeds, that is also exempt from tax. That is what EEE is. But in this budget, one proposal that was brought in was that if you contribute more than 2.5 lakh rupees to the EPF in a particular year as the employee's contribution, then the interest you earn on that will not be tax free beyond that 2.5 lakh. So that was the provision that was brought in the budget. It created a lot of confusion because first of all, there was no clarity on which provident fund it applies to, because the wording of the section was recognized and statutory provident funds, and most people don't know what those are. There was confusion whether it applies to PPF and all that. And also there was worry about whether the government wants to remove this triple E status for EPF itself.
Right. So when you say the wording was not clear, so does this apply to PPF or not?
Not really. So if you look at the PPF itself, annually it caps your contributions at 1.5 lakh. It doesn't even allow you to invest more than 1.5 lakh. So even though it broadly says recognized provident fund, the interpretation is that it applies only to the employees provident fund in this case, which is the EPF.
I also read that there were some changes to the finance bill, amendments made to the finance bill. So does that change this entire 2.5 lakh cap?
Not too much for you and me.
Okay.
So actually there was a lot of protest about this because people felt EPF is one of the most popular avenues for people to put away retirement savings. As we know, most Indians of this generation are staring at a retirement crisis because we are all in the private sector. We are not going to get pensions. Even government employees who joined after 2004 don't get pensions. They contribute to NPS, right? So EPF has been a sort of an autopilot kind of retirement saving for everybody. And as people get closer to retirement, they tend to max out their VPF, voluntary PF contributions. So the worry was that basically if the government is going to tax something beyond 2.5 lakhs a year in this, right? So, but the finance bill was passed last week. Basically, the finance bill is actually what gives legal validity to the budget provisions. In the finance bill, one small amendment was made to this provision. So the amendment actually said that if the employee's contribution is to a fund where there is no contribution from the employer, in that case the limit will be raised to 5 lakh rupees.
Okay.
So this was interpreted in various ways by different people and a lot of media debate about it. But from a proper reading of it, what comes to light is that perhaps the government only meant to exempt general provident fund from this provision.
Okay.
So general provident fund alone, the government wants to give a 5 lakh limit for this tax-free interest.
Okay.
What is general provident fund? It is a fund basically to which government employees contribute their PF, just like we have EPF. Now, general provident fund is not open to any private sector employee. From 2004, if you know, all the new government employees who have joined, they contribute only to NPS and the employer chips in. General provident fund doesn't get any contributions from the employee. So, from reading this, it looks as if the government wants to give this higher 5 lakh limit to government employees because it feels it is not chipping in their provident fund. For private sector employees, it wants to keep the limit only at 2.5 lakh a year for tax-free interest. So it looks as if there is no major change for you. And from April 1st, 2021, if you want to contribute to EPF, up to 2.5 lakh, you will enjoy tax-free interest. Beyond that, actually, in that each year, actually, you will have to calculate the excess that you've contributed, the interest that you want, and actually pay tax on it just like you do on your bank fixed deposits and other revenues.
So essentially, what was a tax-free instrument may be taxed if you are contributing a lot. So that takes us to the key question whether or you should continue to contribute or should you not look at this as a great saving option.
Not at all. You should continue to contribute because this EPF is a strange vehicle which has been completely immune to the interest rate environment in the country. If you see, look at the history of EPF interest rates, they've gone down from about 9.5% 10 years ago to 8.5% now.
Yeah.
Even recently, we heard that for FY21, again the fund has recommended a 8.5% interest rate. Now, this is a completely government-backed vehicle, so it's practically a sovereign-backed vehicle giving you 8.5%. You know, today when you compare it to other alternatives, like say Public Provident Fund PPF this quarter is giving you 7.1%. 10-year government bond, if you buy and hold it, it's giving you 6.1%. So 8.5 is far higher than these two. Whether or not 8.5 is taxed or tax-free comes later, but the interest rate itself is quite attractive compared to these two. But I would also say don't rely only on EPF for your retirement savings because today you're getting 8.5 but you don't have visibility about the future earnings till you retire, right? We don't know how the portfolio may change or the funds accounting may change. Second thing is if you're investing for the long term, if you're more than 10 years away from retirement, fixed income cannot really give you that amount of a kicker over inflation. So it is very important to have an equity component along with your EPF in order to save towards retirement. But certainly you should not be cutting back on your EPF just because of this interest becoming taxable this year.
To sum up, you need not change the way you invest in EPF just because of this new law. But at the same time, this cannot be your only wealth generating tool. So look up for more investment options and more products on PrimeInvestor. Thank you.
Thank you.